avoid that depreciation, that depressing depreciation. Now we're going to talk about business use of home, otherwise known as the home office deduction. Now, keep in mind, this chapter is only dealing with individuals who are self-employed. So employees, it's kind of a shame because it used to be, again, that employees could take advantage of business use of home or home office deduction if they had enough to, it used to be an itemized deduction. There was still a threshold they had to get over. It was 2% of adjusted gross income, but still it was something. And then this changed in 2017, starting in 2018. And then in 2020, we had COVID, where all these people started working from home, but the deduction was no longer available. So the timing of it really couldn't have been worse. But just kind of to keep in mind that this does only pertain to individuals who are self-employed. So usually we don't have any deduction personally for personal residence other than the home mortgage interest deduction and property taxes, and that's if we itemize our deductions. However, if you're self-employed and you use your home for, and you meet the requirements, you can deduct a portion of your personal expenses from your home as business expenses. So we have to do, when we think about this, we have to do a couple things. First off, we've got to determine whether or not we meet the criteria for business use of home, and we'll go through what that is. And then we have to determine, well, what types of expenses would be included in that. And then how do we calculate those, right? Because if we're just using a portion of our home, how do we calculate what portion of our expenses are related to our business or not? So first off, the home has to be the principal place of business or place where the taxpayer meets patients, clients, or customers. So this is the exclusive regular use of the home. So the use has to be exclusive and it has to be regular. So by exclusive, they mean that's all that's happening in that space. And it has to be on a regular basis. It can't just be sporadic. Principal place of business or where the taxpayer meets patients, clients, or customers. Exclusive use test is satisfied if a specific area of the home is used only for the trade or business, such as a separate room, although it doesn't have to be a separate room. It could be a part of a room, but it has to be only used all the time, only used for business. So if you use your dining room every day of the year, you've got it set up as your office, you've got your laptop on the dining room table, but on Thanksgiving, you clear everything away and you eat there, your Thanksgiving dinner. Now it's not exclusive use anymore. So by exclusive, they mean exclusive. That's all that you can use it for. For the regular use test, the taxpayer has to use the home office on a continuing basis, so not just occasionally or incidentally, right? So on a regular basis. Here are some of the considerations that they've used to determine whether this test is met. What is the relative importance of the activities performed at each business location? What is the amount of time spent at each business location? Business home use would also include administration or management activities if there is no other fixed location to conduct such business. So think about this if you're like an independent insurance agent, and you usually meet your customers and your clients at their home, but you use your home, you've got a room in your home where you do the administrative stuff. You do the billing, you submit the insurance policies, all of that stuff. That would then count. Even if you were not exclusively, like you were predominantly out with your clients, you still are regularly using that space at home, and you're only using it, exclusively using it for business purposes. So we've got an example here of Rob, self-employed independent, it's an insurance agent. I did not read that beforehand, but works exclusively from 2 rooms in his home. rarely meets clients at his home. Most of his client contact occurs over the phone or at the client's home or office. Even though most of Rob's client contact is done in his home, all of the administrative work is completed in his home office. The 2 rooms would qualify as long as they are used exclusively for business. You can't use them for anything else. It can't be a part-time extra spare bedroom where guests stay, that sort of thing. Also, and they talk about this here, what I was just talking about, prior to 2018, employee could deduct the home office if it was for the convenience of his or her employer. However, that deduction has been limited. It used to be a Schedule A deduction subject to 2% AGI floor. Just like the medical expenses is 7.5%, this was 2%. All right, how do we do this then? If we meet that exclusive and regular use. So it has to be reported on what's called Form 8829. We'll take a look at that, which then all of the calculations for the home office are done on that form, and then the bottom line number is transferred to the Schedule C as part of the net income from self-employment, okay? So it's all part of that Schedule C. So first thing you have to do is calculate the area in square footage that is used regularly and exclusively for business. Then we take the proportion of that to the total area of the home. So here we've got Rob. It's a 3,000 square foot home. The 2 rooms are 750 square feet each. So he uses half of his home for business purposes, as long as, again, it meets those criteria. So there are 2 different types of expenses for home office. There are indirect expenses. Those would be things that are expenses that pertain to the whole home. Property taxes are on the whole home. Insurance is on the entire house. Mortgage interest is on the entire house. And then we have direct expenses, things that are directly related to that space. So, for example, if those 2 rooms, he needed to paint them for some reason. Even though he's not meeting with clients there, but he needed to paint them. But he's only painting those rooms. That's a direct expense just on those rooms. If he had a new roof put in, that's an indirect expense because it's going to cover the entire house, right? So again, direct expenses, those only for the business part of the home, and then indirect expenses. And again, did I write this book? No, I didn't. Repairs and painting expense for the business portion are direct expenses. Those are deducted in full, 100%. So you don't have to calculate the percentage of square foot usage, okay, in those cases. When it's a direct expense, you're just gonna expense all of it directly. Indirect expenses would be things like insurance, utilities, taxes, interest, and so on. Indirect expenses are multiplied by the business percentage that was calculated earlier in that example, and it's also calculated on part 1 of the 8829. Now, there is a limit to how much can be deducted. Home office expenses that are not otherwise deductible. So those things that if you didn't have a Schedule C and you didn't have a home office, you wouldn't be able to deduct them anywhere on your tax return. Like insurance, your home insurance, if you don't have a business and you don't use your home for home office, for those purposes, your home insurance isn't deductible to you. Utilities aren't deductible. Depreciation, you can also depreciate the area of your home, by the way. Depreciation isn't normally, for personal purposes, isn't deductible. So those types of expenses that are not otherwise deductible are limited to the gross income from the business use of the home. So what we have to do, and you'll see on the Schedule C, remember it said tentative profit? I don't know if you remember that. We did all the income at the top, and then we had the area of expenses, those 2 columns of the expenses. The line, once we subtracted our expenses from our profit, the line didn't say, net income. It was tentative income. That's because it's tentative because we're going to use that to determine how much of the home office expense we get. The home office expense doesn't get listed under the other expenses. It gets calculated separately down below the other expenses because it's limited to what our tentative profit is. So our gross income is reduced by the amount of regular trade or business expenses. So that's what's on our Schedule C, all of those regular expenses in those two columns. So we take those out first. Home office expenses that would be deductible in any event. Mortgage interest and property taxes come first because those are deductible under Schedule A, right? Those come first. If there's anything left, then we will we will expense these other items. So the business use portions of insurance, utilities, and depreciation can be deducted, and we take depreciation last. So those expenses cannot bring your net income below zero, essentially. If your net income after these other expenses is zero, you're not gonna get any of those expenses, okay? So here's an example. So here's Rob. He had $19,000 of gross income from his home trade or business. So gross income. Business expenses totaled $12,000. So $7,000 of tentative income at this point. So we do that first. And then we have $9,800 of mortgage interest, $1,200 of real estate taxes, utilities, insurance, repairs, depreciation on the home, which we would calculate. So if we say that the basis of the home is $200,000, 50% of it, based on that square footage, is used for business. And this is this is commercial use of the property, 2.461%. That's his depreciation deduction. Excuse me. This is how we're going to calculate it. We're going to take that first. So our tentative profit comes out to $7,000 here, right? 19,000 minus 12,000. Then we're going to take the interest, 4,900, because we're taking 50% of it because it's 50% business use. The other 50% is going to go on his Schedule A if he itemizes his deductions. If he doesn't, he's just not going to get to take that. Excuse me. And then again, property taxes, we're going to take half of that. We're left with $1,500. Now, we looked up here. We're going to take, utilities are going to be a portion because this is presumably 100% of the whole house. Utilities. Excuse me. I get lights. My eyes are burning out. This dumb cold, it will not go away.
It's brutal.
I think that I'm getting over it, and then I start talking.
Or get hot or something and start coughing again.
All right, so where was I? Okay, so the utilities, presumably this is 100% of our total here. So utilities, we have to take 50% of that. So 1,500 times 50%. So that's 750. So now we're down to 750. And then next up, insurance is going to be 1,700 times 50%. So we're down below zero already. We're not going to be able to take any more than that. We're only going to be able to take 750. We're not going to take the repairs or the depreciation. The limit for the rest of it is $1,500. So if you look at it that way, take these amounts first. And then that's what our limit is gonna be on the rest of the expenses. We can't take more than that. Even though 1/2 of the utilities, insurance, repairs, and depreciation are for the exclusive use of the office, they're still in total gonna be limited to $1,500. The excess is indefinitely carried over, assuming continued home office use, to the following tax year and deducted subject to the limit in that year. But again, it can't bring them up below 0 next year either. But you'll still do the calculation and then carry it forward. The software will do the calculation and then carry it forward. And then you hope that the client, this is why it's good to have clients come to the same preparer every year, because all that information is already in their software. When you get a new client that has stuff like this, you gotta put all that stuff in. You gotta look at what happened last year and you gotta put all that stuff in. Now, there is another option, aside from doing this. You still have to meet the exclusive and regular requirements, but instead of doing all of this calculation, you can take a flat rate per square foot. That flat rate is $5 per square foot, limited to $300 total. Or not $300, 300 square feet. So in this case, this guy is gonna get a better deal by taking the actual expenses, right? Because it's gonna bring his net income from this down to 0 than he would if he were to take the $5 per square foot. Because the largest deduction you're gonna get is $1,500. And you don't get to take the more, it's not $1,500 like after the mortgage interest and taxes, it's $1,500 from this amount here. If you were to take the standard, like the simplified method is what they call it. But still, if you've got a space that is, less than 300 square feet, then it might make more sense. Just depends on what your expenses are, right? You kind of have to do the calculation for both. Here's the form, and this is what it looks like. Here's the calculation for the percentage. So our business square footage and our total square footage. 50% down here, all this stuff. This is a special, so if you have daycare, there are some special rules for daycare. Because daycare is, it's a different beast, tax-wise. Then, this next part, the deduction, you can see what they've got here. They have these amounts separated on the form. So these are the initial, mortgage interest and property taxes are separated on the form. Direct expenses, indirect expenses, so you've got 2 columns for each. Mortgage expenses, real estate taxes, they're listed there. And this is in total, so you're not taking the percentage at this point. When you're entering on the line, you're gonna take the total expense, because you're gonna then apply, because it says here, total it up, and then line 13, multiply line 12 by line 7. That's our percentage up there. Okay, so we're gonna total it up first, and then take the percentage, enter it there. Subtract line 14 from line 8. So you can see here, we've got our tentative profit. We've gotta do the rest of the Schedule C first, because we need this number to determine how much of this we can take. So, and this calculates, subtract line 14 from line 8, $1,500 is our limit, but we had $5,500. So after we take that $5,500, and then we still enter our expenses, direct or indirect, total those up, multiply it by the same percentage up here, and then this is our, let's see, where's the carry forward? Carry forward must be down below. So this is everything before, all of these items before depreciation. Here, enter this, so that's what this is here, 50% of those. Enter the smaller of 15 or 26. So our limit up there, or this, well, our limit is the smaller of those two. Then we'll calculate the depreciation, and that is done, calculated down here, depreciation on the home. So you'd really want to go, so what you'd want to do, you got to do Schedule C first, then enter this stuff in here. Then you got to stop there, enter the depreciation part down here, because this you're going to enter up here. Add lines 14, 27, and 33. 14, those expenses, 27 are limit, 33 was 0, 7,000. Again, so this is the allowable expenses for business use of our home, $7,000. Then down here, so carry over to next year. Subtract line 27 from line 26. So that's the amount that we didn't get to take, that 1,500 limit, the difference between what our other expenses were, so $1,100. And then the depreciation, line 44, 2461. So this is these are going to be used then next year. Let's see, where's the carry forward part? Okay, so like here, carry over prior year excess casualty losses and depreciation. So from last year, if there was an amount down here, that would go, where'd I go? Here, yeah, here. And then carry over prior year operating expenses, this 1,100 next year will go here, okay? $5 per square foot, maximum of 300 square feet would be the other way of doing this other than taking the percentage and figuring out all the expenses. Generally speaking, the actual expenses are going to be a better deal, but it just depends on, you know, if it's a small space or, you know, your mortgage interest, all that stuff is small. And then, like I said, the remainder of that mortgage interest and real estate taxes, you can then take on the Schedule A if you're entitled to take those itemized deductions. Questions? That's the home office deduction. Regular and exclusive use. Apportion the business portion to do the calculation to determine what percentage is business use based on square footage. Direct and indirect expenses. Direct expenses, we're going to take 100% of those expenses. Indirect expenses, we're going to use the proportion that we calculated. And then we are limited, we're going to take our mortgage interest and property taxes first. And then if there's anything left, we can then take our other expenses, but depreciation is last. And it can't bring us below 0.
But the other two don't matter, whether utility or insurance go first, it doesn't matter.
Yeah. You just use you can use the form to do the calculation. Right there. All of these, you can use the forms to do these calculations. The calculations are right there on the forms. All right. Business bad debts and business casualty losses. So bad debt losses, everybody knows what bad debts are, right? You charge somebody for something and they never paid you. So for usually in order to get any tax benefit from that, you can't be a cash basis taxpayer. Because remember, take a deduction, and this is a deduction, usually there has to be some income over there that matches with that deduction. For a cash basis taxpayer, there was no income. Like when you're on an accrual basis and you have that accounts receivable sitting out there, it's been on the books, it was recorded as income. But when you're cash basis, if you didn't receive the cash, you never recorded it as income. So the fact that somebody doesn't then pay you just means that that income's never gonna show up on your taxes. Like you don't get a deduction for income that you didn't get, that you didn't already pay tax on. So there's nothing to offset. So those business bad debts only, and there is a spot on the Schedule C for business bad debts, but that is for for non-cash basis taxpayers. So if you're on an accrual basis, and remember it was really high income levels where that accrual basis would be used, like I know it was $26 million over the last 3 years on average. In that case, then you would have to be accrual basis, and then you may have some bad debts. That then acts as an expense if it's a business bad debt. So generally the rules for deducting these expenses also apply to bad debts. So if the debt were considered a bona fide business bad debt, it must have been ordinary, necessary, and reasonable in the trade or business. We have this distinction between business bad debt and non-business bad debt. Non-business bad debts actually are deductible. So if you lent somebody money and they didn't pay you back, you can get a deduction for it, but you've got to have some pretty good substantiation for it. It's treated also as a short-term capital loss, and it can only be deducted when it becomes completely worthless. This is a non-business bad debt. Business bad debts can be deducted when either partially worthless or completely worthless and are treated as an ordinary deduction. But again, you have to have included that as income at some point. You don't get a deduction for it. So say you sold a sofa. Say you're a furniture company and you sold a sofa. So yes, you are out the value of the sofa, but you counted that as an expense when you calculated your cost of goods sold. Because when you sold it, then you, remember, we're doing it on an accrual basis for inventory purposes, but so you've already got the expense of what you paid for that sofa calculated in, so you don't then get another deduction when they don't pay you for the sofa. Does that make sense? Does it? Really? I'm not convinced.
If that's a specific example, yes.
Okay. If it's a service, so say you're an accountant and you prepared a tax return for somebody and they never paid you for it, right? You're not out anything for the service. It was your time, right? You're out the time, but you don't get to value your time as far as getting a deduction for your time because you never claimed the income in the first place. You charge somebody $500 to prepare their tax return. They never paid you. You never claimed the $500 as income in the first place. So you don't get to then expense the $500 if you never claimed it as income, right? You're out of luck and you're not going to prepare tax returns for that person again, but for tax purposes, that's not going to, you're not going to get a bad debt for it. So it has to be a bona fide debt for a business debt that arises from a debtor-creditor relationship based on a valid and enforceable obligation to pay a fixed sum of money. For a note or account receivable to be considered debt, the receivable must have been previously included in income. That's the part there, right? Which we don't do when we're on a cash basis. Cash basis taxpayer cannot write off as a bad debt any account receivable that is not collected because the receivable has not been included in income. Therefore has no basis and no deduction is allowed. So here we've got Mateo, cash basis sole proprietor, consultant, gave advice to a corporate client that he billed $700. Subsequently, the corporate client went out of business. I guess it was really bad advice, and filed for bankruptcy because the $700 receivable was never included in income. Mateo cannot take a bad debt deduction. Now, in addition to the $700 bill for the consulting services, Mateo lent the corporate client $5,000. Mateo, you're a bad businessman. Evidenced by a valid note to help the client pay bills and avoid bankruptcy. The business purpose of the loan was that the corporate offices were a source of many client referrals for Mateo's firm. When the corporate client later went bankrupt, Mateo, could take an ordinary deduction for the $5,000 because he's actually out the money, right? And he did pay because it was cash. At some point, he paid. It was income to him, and he paid tax on it, right? So that's the other side of that. If it is subsequently recovered, then you've got to include the recovery amount in gross income in the year that it is recovered. Okay. All right. Questions about bad debts? Okay. Business casualty losses So, there are a lot of people in a lot of businesses in Florida right now that are gonna be interested in some of these things. Individual taxpayer, remember, reports a business casualty loss on page 2 of Form 4684. Business property, though, when it's lost in a fire, storm, shipwreck, theft, or other pirates, or other casualty, taxpayer normally receives an ordinary loss deduction for the basis of property unless the property is only partially destroyed. With partial losses, the loss is the lower of the decrease in fair market value before and after the casualty or the adjusted basis. And of course, we've got to reduce all of it by any insurance proceeds that are received. You can have a gain. So can you have a casualty gain? Yep. Business building purchased in 1986 for $55,000, is now worth $200,000. It's insured for replacement cost if the building were completely destroyed by fire and the insurance proceeds were $200,000. The taxpayer could have a gain of that whole $200,000 if they had depreciated that building fully, so there was no basis left, unless the building is replaced, and we're not going to do chapter 12 there. But anyway, so an example. We'll take a look at this. So September 17th, Dwayne's office building was destroyed by a tornado. He had purchased the building in 1987 for $90,000, but had recently made improvements to it. So the adjusted basis, which is our cost less accumulated depreciation, and fair market value of the time of the tornado, were $80,000, adjusted basis $80,000. $110,000 was the fair market value at the time immediately before. He had not updated his insurance policy for several years and only received $70,000 from the company. Because the building was totally destroyed, the business casualty is $10,000, which is the adjusted basis of $80,000 less the $70,000 insurance reimbursement. That $10,000, we're going to put it on Form 4684. Don't worry too much about that stuff. And then 4797, we're going to deal with this 4797 in the next chapter here. Although the loss relates to Schedule C, it does not appear on Schedule C. It goes directly to Form 1040 as a 4 AGI deduction. So it actually gets to reduce the AGI. So this is the form that gets filled out for that. This is the 4684. So all the whole calculation is there on the form. There's this $10,000 deduction. So that is going to reduce his taxable income before it's going to reduce his AGI by $10,000. All right. Questions?